Hello everyone, welcome you back to another interesting session which is all about PE ratio. So you must have heard everybody in the market talking about PE ratio. What is a PE ratio? Price to earnings ratio. So what is it? So in the YouTube content you will always get a standard sort of explanation for PE ratio, which is nothing but the total price or the market cap of the stock to its total earnings, or otherwise it can also be found out by just dividing the current market price of the stock to its earnings per share. So that is all known to you. I am not going to decode it here. I will be decoding what is the exact relevance of PE and how it works. So the famous investor Peter Lynch once mentioned that PE ratio is nothing but the number of years taken by the company to return back your initial investment, assuming of course the earning growth every year is the same. So if you say DMart is having a P ratio of say 100, then it's like you have to wait 100 years to get one earning or $1 earning or 1 rupee earning from DMart. Obviously, if the earnings growth rate ramps up, say the profitability by the company increases very fast, then the denominator, which is price to earnings, the denominator is earnings. So if that earnings increases, then the PE ratio also contracts. But if the earnings ratio is constant, as I told, then an 100 PE is interpreted as it takes 100 years for you to return your investments. So obviously, if the PE ratio is substantially higher than the growth rate of that company, then obviously it is highly overvalued. Now let's decode how it actually works. Say for an example, Zudio, where you get the clothing, which is basically the trend group of Tata. You went to Zudio. So during June or July, you saw a dress, say a t-shirt. So it's costing you around 1,200 rupees. Now you wanted to buy that, but you think that the price is high, so you cannot buy it. So you won't buy it because you don't have a bargaining power there. So you leave it at it and then you wait for the discount sale to happen, say in December. So during the festive season or during December, you will get a discount sale. Then during that time, you visit Zudio and the same shirt, you will buy it at a half the rate, which is like 600 rupees. So 1,200 rupees has now become 600 and you are buying the same stuff, but you have to wait for some time. So this principle is similar in case of a stock as well. If you see the stock is available at some higher valuations, but the business is good, you want to buy it, then you will have to wait for some time patiently for some macro events to happen or some microeconomical events to happen so that the stock is underpriced or it goes low in price, then you enter the stock. So your profits are much higher because if you are buying it at a discount, just like value investing, then the returns also, as it moves up, is much higher than you are buying the same thing at a higher valuations. So you will get it at a lower price to earnings if the stock is trading at a lower valuation or lower price, then you can have greater returns from that. But unlike, like I told in case of Zudio, if you are having tomato, you are having 1 kilo tomato, say available at 50 rupees today. Now you will bargain with the vendor and tell that, no, this tomato I will buy it at 40 rupees if you are giving me in that rate. So if vegetable vendor is desperate to sell it or he is closing the shop or something like that, then he may give you a discount of 40 or at 45 rupees you can buy it. So this case doesn't happen in case of stocks, because stocks you cannot go or ask for a bargain. You'll have to wait for the stock to correct, then only you can buy. Also, the other part of it is that lower P always doesn't mean that the stock is undervalued. It can be interpreted as undervalued, or it can also be that it's a bad company. In the sense, if the profitability or the business done by the company, it's not good, he is not generating much profits, then the investor mob will understand this and they will not buy that stock. So if you don't buy that stock and if your earnings, which is in the denominator for the PE ratio, kind of remains the same, then the price keeps falling and the PE ratio can go low. Even though if the earnings are also dropping, the price may also drop along with that. So the overall PE ratio keeps going down, which doesn't mean that it's an undervalued stock. Now the other part of it is that if the PE ratio is going low because the earnings is going at a very high rate and the investor is not identifying that and the PE ratio goes very low, it's a case of undervaluation. Now while comparing PE, you should always compare with its industry peers. In the sense, the PE of say steel companies or say high end manufacturing companies who is having big plants and machineries can be very low compared to a service oriented business like TCS or Infosys, wherein it's a service based business and less capital intensive, wherein the future growth rate is anticipated and investors invest in that. So based on the futuristic growth rate, the investor is pricing the stock and hence the PE ratio or the PE valuations would be higher compared to a normal manufacturing company. So the thing is that always you should understand that the PE ratio is a function of the growth rate of the company. If the growth rate is high, or else if the investors are anticipating there will be a higher growth rate going forward, then there can be a higher PE. So it may not be always overvaluation, but in anticipation, if the investors are buying this, then obviously if it is a higher PE, then it leads to overvaluation. Now, as I always say, Warren Buffett had told that price is what you pay and value is what you get. In the sense, price, you know the current market price in case of say Zudio sale or in case of tomato also. So you know what is the price which they are quoting. But you think that it is not a 1200 rupee cloth, it is 600 rupees cloth. So 600 rupee is what you are valuing the shirt as, though the price quoted is 1200. So you will have to wait for the cloth to become 600 rupees, or you have to do something wherein you will get it at 600 rupees, then only you can buy it. So value and price, there is always a mismatch in the industry. As we value investors, as I always say, you should always go for or understand the valuation, value the company, then see the price, and if it is undervalued, is it trading at its intrinsic value or below intrinsic value with a margin of safety, then only you should buy that stock. Otherwise, there is always a day wherein the stock price may fall and then only you can buy. But patience is the key. So as I told, growth is something which is important. So we should look at PEG ratio, the price to earnings growth. So if this PEG ratio is lower than 1, then it is undervalued, and also it is growing year on year. The earnings is growing year on year. So PEG is nothing but the share EPS, the earnings per share, divided by the EPS growth rate. So how the EPS, the profit is increasing year on year, 10%, 15%, 20%, etc. So this will give you the earnings per share divided by the earnings growth rate, which is nothing but the PEG, will give you whether the stock is undervalued, fairly valued, or overvalued. Undervalued less than 1, fairly valued is like 1, and if it is more than 1, it is overvalued. So if the earnings is growing year on year, then if you see that along with the PE, so growth rate is there and the PE is evaluated, then only you should consider looking at the stock or getting into the stock. So you should always know that growth attracts capital. So if a stock is growing fast, then the capital is deployed by the institutions or the investors and the stock price shoots up, again increasing the PE. But again, if the earnings doesn't catch up with that price, then the PE ratio becomes very huge and if the earnings cannot sustain it, then later on a later date it can go down. So there are two phenomena here: PE expansion and then PE contraction. So if you see small cap companies, they are very small in capital, their business is fast growing, so we can expect 20 to 30% growth in that, earnings growth in that, revenue growth, then earnings growth, profit growth, everything. So if that earnings is there, even though the price goes up, the earnings grows so fast in a very high pace that your PE is always low and you will get it at a lower valuation compared to large cap companies. So I will just compare it with a developing nation and a developed nation. So India is a developing nation. The GDP growth rate is very fast in the rate, say 7%, wherein US is a saturated developed country, wherein their GDP growth is say 1 to 2% or 3%. So the fast growth is because we are about to become developed nation in say 2047. So USA has already become a developed nation, so their growth rate is low. So if their growth rate is low, just like your stock, if you see small cap, it has lot of growth potential going forward, so the growth rate is high. Unlike a large cap company, just like HUL, Hindustan Unilever Limited. So in that, the stock has already saturated, become a large cap, and growth rate is very low. Even you must have seen that some companies doesn't have a PE because their earnings, their denominator itself is negative. How can it be negative? Because if the revenue is there, but they are not making good profits, there is no profit after deduction of tax and financing cost, interest cost, etc. So you will have, say a company is having negative earnings minus profit after tax. So in that case, earnings is negative means price to earnings is negative. So you cannot have a PE. So it is mentioned as 0 or dash. So don't worry about that. So don't look at such companies unless and until there is a turnaround story associated with that stock. Otherwise, if the earnings is not there, obviously you should not consider buying that company. And of course, investors invest in high PE companies expecting that in future it will grow exponentially. There may be a story associated with that. Maybe a company is venturing into some JV and going to produce some quality products which is of very high value going forward, something like that. So basically, as Warren Buffett once told, there are two factors wherein PE can be impacted. One is investors' future prospects, expectation about the company, so they will price in and the PE catches up. And second thing is interest rate. So if the interest rates are cut by the Fed or your RBI, then in that case your cost of capital is less. First thing is that your FD is less, fetching you less interest, so you will not put it in FD, you will invest somewhere. So where is it? In stocks. So in stocks also, if the interest rates is low, then the profitability for the company is high, because if a company is having high leverage, they are having debt, and the interest paid by for that debt is less because your interest rate is low, so it will again boost the profitability. So more investors investing, then also the earnings is very high because of higher profitability due to lesser cost of capital, because of less interest payment for the debt. So this will all impact the PE ratio as well. So now the $1 million question: if you invest in a low PE stock and if the PE expands and the price shoots up multifold, say you had invested at a PE of say below 10, then the PE reached some 80 PE. So should you sell the stock? So what I would say is that earnings may not be steady always for a stock. There will be some macro things coming in, or maybe some micro internal organizational things coming in wherein your earnings can be impacted. The raw material cost goes high or something like that. So you may not have a steady PE, or you may not have a steady growth rate also. But as you stay invested in a company, and if you have a growth visibility and your earnings eventually catches up, and the PE, though it has expanded, it will contract and your valuations becomes more attractive because the earnings rates grows fast with respect to the company's current traded price, and the earnings is supposed to catch up with the price. But many a times there will be earnings manipulation as well by various companies, wherein the income from other sources or one-time sale of some property plans or something, wherein even though they are not generating profits from their operations, one-time deals can show some revenue, and this will be only one time, so this should not be considered as a earnings growth. So you also should be intelligent enough to evaluate that while looking at a PE. Also, higher PE is very dangerous because if the market corrects, then the higher valuation companies having very high PE can steeply fall, which is not in the case of a lower PE, generally speaking, from my own experience, wherein if you are investing in PEs less than 10 to 15, then in that case the stock is not overvalued and the earnings is there for the company, and the stock going steeply down is limited. So in summary, if you see, high PE ratio reflects the company's strong growth, good fundamentals, high operational efficiency, leadership in a particular sector, and also another thing is that scarcity of peer stocks in a particular sector, otherwise called scarcity premium. So a semiconductor company is there, so only 2-3 semiconductor companies there, not like 15-20. So then you are bound to invest in only those listed semiconductor spaces. So here in India, if you see, I am researching on semiconductor stocks and I have been putting a lot of videos on that. So majority of the stocks are having very high PE and very high price to book value because they are already priced in by the investors, and because of that the valuations are much stretched. There are a few companies wherein valuations are fair, like HCL Technologies, which I have been discussing in the various sessions through my YouTube channel. But still majority are highly overvalued because of the scarcity premium. And the last one is investors' long-term optimism about that stock. So this will all lead to very high PE. So it is your intelligence wherein you are entering the stock at a lower valuation, identifying the growth of the company, and then investing at a lower price wherein the PE expansion is starting, and once the PE expansion starts, it will go much higher and much higher valuations, and then earnings eventually catches up and the PE contracts. So basically speaking, PE cannot be looked in isolation. You have to look at other ratios like PEG. So price to earnings should be looked in conjunction with this PEG ratio, price to book ratio, ROE, ROC, and other factors also. You cannot look that in isolation. But PEs these days discussed very well by these media hypes and all, wherein just looking at the PE, they are telling that the stock is undervalued, which is very wrong. So as a rule of thumb, the earnings growth rate should be at least half of that of your PE ratio, so that your investing makes sense. If the growth rate is very low, then there is no point of investing in a highly overvalued stock, even if it's a well-known stock, very powerful or very strong stock. So many companies like HUL and all, they have hit their complete growth rate saturation, then they are flat almost. The stock PE also is almost flat for many years. So the PE is there maintained by their dividend yield. So they give consistent dividend, and this dividend can push the investors to invest in such stocks, because even though the growth rate is low, the stock may not grow much, but you are getting consistent dividend. So for such high dividend yielding stocks, the investors would buy the stock and hence the price goes up. So a constant PE is maintained, though the earnings is not growing fast. So just for getting the dividend, though there is no much growth rate in the stock, the investors invest in some stocks like HUL, wherein the PE is not increasing but stable over the period. So PE is something which is very important end of the day, but you should always, as I always tell, look in conjunction with others valuations, then only you should invest in that stock. So PE contraction, PE expansion, the application of PE, all these things we have discussed in this session. If you have any questions on this, you please feel free to comment in the below comment box. See you in next video. Till then, happy investing.